Let me show you why so many people lose money in the stock market. Stock A is trading for $100 a share and pays out a 5% annual dividend, while stock B also is trading for $100 a share but is paying out an 8% annual dividend. Which stock is going to pay you more money? Most people would say B because 8% dividend is bigger than 5% dividend, but the real answer is it depends. Let me show you what I mean. Let's use a real life example. UPS is paying out a 7.5% annual dividend versus McDonald's, the stock, is paying out about 2.25% an annual dividend. This is where many investors would tell you that UPS is going to make you more money because it's paying out way higher dividends, but you got to look a little bit deeper. If we take a look at the last 5 years, the UPS stock has fallen by almost 50% versus the McDonald's stock has grown by around 50% in the last 5 years, which means the person that invested in McDonald's 5 years ago is way wealthier than the person that invested in UPS, even though they're paying out a higher dividend, because you have to look deeper than just what the dividend is paying. These types of little mistakes can slash the value of your wealth, but not anymore, because in this video, I'm gonna go over 7 of the biggest investing mistakes that I have seen so you can stop doing these things. And I have to give credit where credit is due, because the inspiration for this video came from watching a video on Joseph Hoag's YouTube channel. He published a video titled 7 Mistakes That Will Cost You $1.3 million. It's a great video, and if you want to check it out for yourself, I will link it for you down in the description. Mistake number 1 is investing based off of dividends, not based off of the asset. I like investing for cash flow because when you have enough dividends coming in from your investments, well, you can quit your job and still have the cash flow coming in to fund your whole lifestyle, and you don't have to go to work to get paid. But there's a lot of mistakes when it comes to investing for dividends, and number 1 is investing based off of the dividend. So if you see a stock trading for $100 a share and they're paying out a $3 annual dividend, that means that this company is paying out a 3% annual dividend, which is pretty standard. But now take a look at this. What happens if the stock price falls because something is wrong with the company? And let's assume now that the stock price goes from $100 a share to $50 a share, but the dividends haven't changed yet. So if this company is still paying out this $3 a year dividend, well, that means the dividend is actually now 6%, not 3%. This looks a whole lot more attractive, but the part that you're missing when you just look at the dividend is the actual stock value itself. Now, if the stock price fell because people are confused and don't understand what's going on, it's just concerns about the economy, but the company is great, this could be a great buying opportunity. But if the company is falling because it's on the verge of bankruptcy and they just haven't had the chance to cut or slash their dividends yet, well, now you could come in and buy on the way down to zero. Now, not only do you lose the value of your asset, but you also lose your cash flow, which is why when you do analysis for dividends, you have to look beyond just this. You have to take a look at what asset are you buying. Is it a good company? Is it a good stock? Is it a good valuation? Is it a good CEO? Is it an innovative company? These are the questions you want to be asking. Mistake number 2 is you follow what's hot instead of what the research says. If you're like most investors, you go onto Yahoo Finance, you go onto CNBC, you go onto Reddit, and you read that Palantir is up 50% in 2025. And now you get excited. If this stock has been booming this year, I wonder if it's going to continue booming. Maybe I should go out and buy this stock, which maybe it is a great investment, but the mistake that a lot of people make is now you want to get these great returns by doing what everybody else is doing, because now you're making these investment decisions based off of what's already on the news and what's on the headlines. But the reality is, by the time that news is already broke, the real money has already been made. And the smart investors and the savvy investors, what they're doing is they want to invest before it hits the headlines. How do you do that? By investing based off of data and research. Because now you don't want to react, you want to be proactive. Because if you don't want to get the returns as everybody else, you can't keep doing what everybody else is doing. And if everybody is on Reddit and CNBC and Yahoo Finance trying to find the next hot stock, and that's where you're looking, well, you're doing what everybody else is doing, so you cannot expect to get better returns than everybody else. And right now, the majority of people are not doing very well in the stock market, even though we know that the stock market goes up by around 10% a year on average. Mistake number 3 is you're investing when you're not ready. Let's assume that you go out and invest $8,400 into the stock market today, and you never invest another penny again. And you can get a 25% annual return on your money year after year after year, and you do this for, let's say, 30 years. If you do that and you never invest another penny, you are going to retire with almost a little bit under $7 million. And now you have wealth. That way you can do whatever the heck you want with your money. Now I know what you're gonna say. Jaspreet, I don't have $8,400. Jaspreet, where am I gonna get a 25% annual return? Jaspreet, what are you talking about? Well, here's the reality. This is what the average American household has in credit card debt, who has credit cards, and this is about the annual APR on those credit cards. If you are trying to invest your money in the stock market, you gotta be able to do a little bit of math, because the average historical stock market return is 10% a year. If you're paying out 20, 25, 28% a year in your credit card interest, well, it would make more sense to pay this off than trying to get this, because this number is smaller than this number. So if you have high interest debts, such as credit card debt, such as high interest payday loans, pay those off first before you invest your money in the stock market. Yes, stock market investing is great. Yes, that's how you build wealth, but you can't build wealth if you strap yourself down with 100-pound chains on each leg. That's what you're doing here. You're trying to build wealth by putting your money here, yet you're paying out this every single time. So you're taking one step forward and then 2 steps back, which is why you gotta pay out the high interest debts first. Now, for those of you that are investors or wanna become investors, again, my team at Briefs Media publishes a free daily report called Market Briefs, where we break down what's happening in the economy, housing, stocks, crypto, and global markets into a fun, witty, and easy to read newsletter. We have hundreds of thousands of investors that are reading Market Briefs every morning, and as a complimentary bonus when you join, we're also gonna get my investing masterclass, where I'll show you how you can find hidden investment opportunities before the crowd, all for free. So if you wanna get Market Briefs and my investing masterclass all for free, I have the link for you down in the description below. Mistake number 4 is you're investing more than you're willing to lose. In 2022, when the stock market fell by around 20%, I was getting a lot of comments from people saying something along the lines of, the stock market is crashing, I don't know how I'm gonna pay my rent, I don't know how I'm gonna pay my bills. Which doesn't really make much sense, because when you invest money into the stock market, you don't want to be investing the money you need to pay your bills tomorrow. Investing is a long-term game. So when you think about putting money aside into your investments, I don't want you to think about using the money that you're going to need to pay your bills this month, next month, the month after that, or even next year. I want you to take the extra money that you do not spend, that you can just throw away. You take that money and you're gonna throw it away into your investments. Think of it as gone. Hopefully it's gonna grow into something a whole lot bigger. But when you think of it like that, you're not gonna be stressing when markets go down and make stupid decisions, because when markets go down, you don't wanna be selling. That's when you want to be buying even more aggressively, because it gives you a great opportunity to come in and buy good investments at a discounted price. But you can't do that when you're worried about paying your bills. And this ties in very nicely with mistake number 5. Buy when everybody's greedy and sell when everybody's fearful. This is a rough diagram of how the stock market moves. It goes up and down, but over the long term, we have seen that the stock market has always gone up. And the mistake that so many people make is that they come in and they start buying here, when all the news is talking about how markets are going up and everybody is getting so rich, and you don't want to miss this opportunity. So you come in and buy because your Uber driver is getting rich, your co-worker is making a whole lot of money, and that silly neighbor who should not be having all that money is making a lot of money. So you come in and buy, and then you start to hear the news about how the markets are tanking, everybody's losing money, it looks like the world is going to end, everybody's freaking out. So now you come in and sell. So you're buying high and selling low, and you are the reason why so many people are getting rich in the market, and I want you to start to flip that. And what I mean by that is, when you see these downturns, don't use them as a time to freak out. Use them as an opportunity to buy. Because we saw a common denominator happen in 2022, 2020, and then 2008. Each one of these things had a market downturn. In 2022, we saw the stock market fall by around 20%. In 2020, we saw the stock market fall by around 34% at the fastest rate we've ever seen markets fall in the history of time. And in 2008, we saw the housing market crash and we saw the stock market tumble. Well, in each one of those things, some people lost a lot of money and some people became incredibly wealthy. The people that lost a lot of money were either the people that had too much debt, or they got scared, or they didn't know what was going on. The people that made a lot of money were people that had cash reserves and were able to come in at the bottom. People that bought in 2022 were buying stocks at a discounted price. People that bought stocks in 2020 were buying stocks at a cheap price. And after the 2008 crash, people that were buying stocks and real estate during that crash were able to become incredibly wealthy, because you have to have the right time to understand that these things create opportunity when you understand how markets work, because the reality is markets go up, markets go down, but over the long term, we've always seen markets go up. So if you are a long-term investor, not a trader, understand the psychology. That way you don't have to be the person that's making other people rich. You can be the person that's using these downturns as an opportunity to find opportunities to build wealth for yourself and your family. And this brings me to mistake number 6, is you have a short-term mindset instead of an investor's mindset. The technical definition of an investment according to the tax code is somebody who's investing their money into an asset like the stock market for at least 1 year or longer. So holding a stock for 1 year plus, but really the best investors are holding on to their investments for years, if not decades, because you believe in the long-term future of that asset, of that stock. And if we just take a look at the stock market, if you take a look at it over the last 1 year, you'll see how volatile it looks. Over the last 5 years, it starts to look a little bit less volatile. And as you zoom out even more, you can start to see, oh, it doesn't look as volatile. But the mistake that so many people make when they invest their money in the stock market is they buy a stock in the morning, and then by the afternoon, they've already checked the price of the stock 16 times. You check it again and again and again, because now you want to make sure that the stock is only going up in price. The next morning, you check it, you check it, you check it. And that's what starts to create that anxiety and fear, because you want to know the price of that stock in every moment of every day. But think of it this way: if you went out and bought a house tomorrow in the morning, would you be checking Zillow to see what the Z estimate is after lunch or in the evening? No, because you know that this is something you want to buy for the long term. When you buy a stock as a long-term investor, why are you so concerned about the day-to-day price swings? What you want to focus on is the actual asset, the actual value. There's going to be a lot of movement in the stock market, and that can be great for some people, but for most people who don't know how to control their emotions, they turn an investment into a short-term trade because they start to panic as soon as the thing starts to go down. But remember, you don't actually lose any money unless you sell or if the stock goes bankrupt. And so if the stock goes down, you're not losing money unless you actually sell. Well, now you've just lost money, and that's why you got to understand the game as an investor is to own the asset for the long term. And finally is number 7, not factoring in fees. If you have money in a 401k, if you have money in a mutual fund, if you have money in an ETF or an index fund, if you have money with a financial advisor, you have to pay a fee. This fee can be called assets under management. It could be called an expense ratio. But what this fee is how much money you are paying every single year for having your money into this asset. Let me show you why this is so important for you to consider. If you invest your money, $1,000 a month, you can get a 10% return on your money, and you are investing your money yourself and you don't have to pay any fees. Well, over 40 years, your investments, your $1,000 a month, are going to grow to right around $5.8 million. Not bad. But now let's assume that you put your money into some low-cost fund and you're going to pay a 0.2% fee. You're still investing the same $1,000 a month, the same 10% a year, and you do this for 40 years. But now instead of having $5.8 million, you are going to have $5.5 million, which means, yes, you paid out around $300,000 in fees over the course of 40 years. So yes, it was a small little 0.2% fee, but there is a cost to that fee because your fees are also compounding while your money is working to compound for every dollar you invest and for every dollar of profit that you gain. But these fees can be worth it when you are getting good returns and when it helps you actually invest your money, because some people can't do this. Some people need those funds or advisors to help them with that. If you're working with mutual funds or financial advisors that are going to charge you a little bit more, it might be a 1.5% fee. Now, if you invest the same $1,000 a month, 10% a year, you're paying a 1.5% fee over 40 years. Well, now you're not going to have $5.8 million, you're not going to have $5.5 million. You are going to have closer to $3.8 million, which means, yes, your advisor is going to take $2 million over the course of those 40 years. For some people, this will be worth it because if you don't do this, you're not going to be investing your money. So yes, this is better than having nothing, but you want to understand the cost. That way now when you're thinking about how you invest your money, you can also think about fees, because a small adjustment in fees can result in hundreds of thousands of dollars or millions of dollars in more gains for you. The average person doesn't even know that they're paying these fees, which is why it's so important for you to understand the power of small incremental changes in the growth of your portfolio, because small changes can add up to big dollars over the course of your investing career. This is one of the things that we talk about in Briefs Pro, that if you learn how to be more of an active investor and can find ways to get slightly better returns on your investments, that can add up to a lot more dollars over the course of your investing career. Again, if you want want to learn more about that, you'll get a free investing masterclass when you join Market Briefs. So if you want to learn more, I have the link to Market Briefs and my investing masterclass for you down in the description. America is entering a death spiral.
When debts rise relative to incomes on a chronic basis, right now for the U.S. government, it's almost $1 trillion a year that goes to interest payments. When you run a large deficit, you have to sell debt to do that. And when I calculate it, the quantity of debt to be sold is much